Ladies and gentlemen, this is Current Yield, Grant's Interest Rate Observer of the Air. I am Jim Grant, and with me today, as always, Eric Whitehead, who is at the console, spinning the dials. He's our engineer. And Evan Lorenz, the great Evan Lorenz, Deputy Editor of Grants. And our special guest is none other than Bob Farrell, the great market technician who, with Merrill Lynch for so many years, was by himself and his own self for so many years, and is in Florida at the moment, living large, but still, I think, knowing more about the business of buying low and selling high than most of us who do it every single day for pay. So, Bob Farrell, welcome to Grant's podcast.
Thank you, Jim.
We have known each other for what, 102 years or
at least that.
Yeah.
At least that.
Bob Farrell was actually born at the bottom, no? Were you born around July 5th, 1932?
No, I wasn't born until November 15th, but
you almost
it
got
was
the
in
bottom.
the general region of a major low in secular trends.
Would you consider this a major low, Bob?
Where we are now?
Yeah.
No.
We've been going down for as many as 7 or 8 days? People are panicked.
Well, I think people are clearly concerned, but I don't think I detect panic, except there are individual stocks like Pacific Gas and Electric today down 25% on news. But in general, we're seeing some things show up like a pickup and put buying, but I don't see extreme fear or any kind of extreme fear, not at this point yet.
What does this moment in markets remind you of? I ask because it seems we have been living through rather extraordinary times. We have had 10 years of, not quite 10 years, we've had many years with the juxtaposition of depression level interest rates and boom time asset value. We have had, on the authority of Richard Silla, the very knowledgeable financial historian at NYU, we have had interest rates we have not seen in some cases for 3,000 years. And we have had a regime, supposedly, of the final triumph of passive investing over the active kind. All of these things have come together more or less at this moment. And how do you begin picking apart what is new and what is the same in markets? We seem to have some of both.
Well, my opinion has been for some time that we live in or with distinctive markets. There's been a lot of change ranging from computerized trading, decimalization, algorithmic trading, dark pools, elimination of the uptick rule, and specialist system virtually gone, and decline in stocks traded by 50% in the last 10 years, more ETFs than there are stock traded. And the banks taking a larger percentage of trading on the close, which had previously been mainly done on the exchange. And these things all contribute to a different market, as I see it. And I consider it the ultimate contrarian market. I think there are traps everywhere. And the traps are related to lack of liquidity, changing rules in the game. I've seen many times here where whatever you see from the market, and I'm not talking about the background interest rate news or what we expect from the Fed, but I'm talking about how the market itself is behaving. And I call a trap when a stock breaks out to make new highs like we did in January. All the averages were making new highs. Threads was making new highs. And bang, we went down 10%. There was no escaping it. And we did virtually the same thing with a bunch of new highs in September. And it looked like onward and upward. Everything is fine because we've overcome all the technical obstacles. And from that, we've started into this more extensive decline. And that enters into my thinking on how things are going to go. It just seems to me you can't use the recent past, let's say the last year or two, as your example of how it's going to behave in the future, how the market's going to behave in the future. I believe that this is a distinctive change that we've had, and you almost see the plan in effect to play against the obvious. And maybe that always has happened. But for example, with all the breakouts that occur, and the breakouts are generally not buy points, meaning upside breakouts, they're sell points. And I think that may relate to algorithmic trading programs that have been designed to take advantage when people are getting most enthusiastic about buying and putting in some sell programs. But I don't know how it quite works, but I do know that there have been a lot of traps. Just take the price of oil, for example. When the price of oil broke out through $72, it was like 4-year highs, and it had all the forecasts coming up with things like we're going to 85, 100. And from there, it was no distribution, just a reversal. And we're down in a straight line like 27, 28%. And maybe that's going to be climactic. But from looking at what the market is doing, it is making it harder and harder to be a good trader, or anybody following technical things like you got to have a breadth divergence before it.
Hey, and now a word from our sponsor, whose name is Purple. So here's a question, ladies and gentlemen. How did you sleep last night? I can speak for myself. I slept a little fitfully because of the mattress. Now, if I had a good mattress, I would not be thinking about deadlines. I wouldn't be thinking of getting up at dark 100 to catch a plane for Chicago. I would not be thinking about the uncorrected proofs of the next book. No, I would be sleeping properly. So you're wondering, how is Purple different from other mattresses? Well, it will probably feel different because it uses this brand new material that was developed by an actual rocket scientist. It's not like a memory foam you might be used to. The Purple material feels unique because it's both firm and soft at the same time, so it keeps everything supported while still feeling really comfortable. Plus, it's breathable, so it sleeps cool. It ends up giving you this zero gravity-like feel, so it works for any sleeping position. So here are the proof points. 100-night risk-free trial, backed by a 10-year warranty, free shipping and returns, free in-home setup, and old mattress removal. You're going to love Purple. And right now, our listeners will get a free Purple pillow with the purchase of a mattress. That's in addition to the great free gifts they're offering statewide. Just text GRANT, G-R-A-N-T, to 474747. The only way to get this free pillow is to text GRANT to 474747. That's GRANT to 474747. Message and data rates may apply. Thank you, Purple. Bob, number 2 of your 10 rules is that excesses in one direction will lead to an opposite excess in the other. We certainly have had seemingly excessive lows in interest rates, very low interest rates. Do you expect this to be reversed?
Yes. I think a 35, or maybe it's longer than that, year bull market in bonds has ended. I think that the odds are that bond returns are going to continue to be disappointing. But I think it's with cyclical interruptions. Like right now, one of the interesting things is the 10-year bond yield has broken out. It broke out around 310, maybe, or 36, and we ran up to 325. So that looks like, we're onward and upward for interest rates. But my feeling is each time we've gotten these kinds, my observation really is each time we've gotten these kind of obvious signals that the markets are on their way to wherever we hope they're going or think they're going, there's a reversal that takes place. And there's been plenty of them. For example, when small caps made their high in September, it was straight down. Everything was in gear, and yet they topped and it was straight down 16% in 2 months. Housing made new all-time highs in January, and they've been down for 9 months, 35%. And in most of these cases, there's no chance to get out on a rally. I think it's a pretty big thing about what happens to interest rates right here, obviously. But I think there's a chance that this breakout we've seen on the Treasury bond yield is not going to follow through. And I don't know what will be the trigger to that, but I think from a technical standpoint, I'm skeptical that this is going to follow through, and that'll have implications for a number of things.
Is this a bear market in the stocks or a bull market in the stocks, in your opinion?
Well, I think you have to judge about where we are now with stocks. Stocks have gotten very oversold and now have had a rebound rally that's apparently failing or going back for some test. But I think the way I'd look at it is if we made the peak in stocks recently, or January and in September, with everything in gear on the upside, I think we're going to make the low with everything in gear on the downside. And my guess is that low is going to come in this between now and the end of the year. We do have a good chance that some seasonal factors will come in, but we're very oversold. But I think if the market breaks either the low we made recently in various averages or the February low that was made this year, I think then it'll look like it's open end on the downside. But we'll already have been down substantially.
Yeah.
I mean, many stocks are in major bear markets already.
One of the things that perhaps is a little bit different today than in many eras in the past is that the Federal Reserve is so much in our lives. It is front and center in the news. It is seemingly the hand that guides us all in our temporal affairs. It's almost as if the umpires were playing the game and the shortstop was in the stands watching them. I wonder if the stocks do break to lows at the end of this year, might the Fed not capitulate in its program of raising rates? And if that were to happen, what might happen to the price of gold?
Well, I think the odds to me is that we are going to get a rally in the price of gold. Gold has acted very poorly for a good deal of the past several months, but it kind of gets down to lower rates for an interim period, some cyclical period. Say the Fed says something like they're not going to be as aggressive in raising rates next year because the economy seems, to be slowing down. I would think with a market that's been already correcting as much as it has, you could get the conditions for a good rally. Now, whether gold rallies kind of depends on whether the dollar responds to lower rates with more strength, because they do seem to go in opposite directions. But I think the chances are that even that bullishness about the dollar continuing to go up may get a fake out in the sense that the breakout doesn't follow through. So I'd say yes. I think there's a chance for gold to do better.
What do you do with money?
Well, Treasury bills are good, and from my standpoint, markets are going to be different going forward. I think on sort of a secular basis, we've seen a secular high in bond prices, and I think we're in a transition to a longer period, maybe several years or maybe a decade of lower rates of return. The last 10 years, if you take 10 years ending October of this year, we have an average return on the S&P, total return of 13.25%. Now that's above the average of 9.8, which is the 90-year average, or some people say that the measure of the market really should be a 7% return. But in any event, we've gone through a series of periods where the market does return to the mean, and the rates of return to the mean, or if that's a little double counting there. But I think from the standpoint of what happens from here, I think passive investing has become the only way to go. I heard recently of someone on a committee in a investment company that has declared that they don't want to, that they shouldn't buy companies anymore. They should just buy ETFs. And we know we've had this huge inflow of money into them, and that has benefited people. Passive investing has beat the active investor, and I think that's going to change. And I think it started to change this year in the first half of the year. And now that the market's gone down, the passive investors are doing better again. But I think this is the start of a change. So one of the things I don't want to do is concentrate money on market passive representations, because I think the returns are going to be below normal, below average. And going into next year, I think the stocks that have been killed the most in advance of recognizing that the stock markets can go down, like the housing stocks down 35%, or some of the oils and material and small caps that had been going fine, and even the regional banks, most of those can do better with lower interest rates. So there's something coming that says to me, I want to make an entry position into more equity, even though right now I'm light on equity and high on cash. But I think that we will have a pretty good recovery from the bottom that we make, as long as the bottom isn't what we have right now. I mean, if this turns in, we get a bounce on the market. That's not, to me, something that you're likely to have a large potential in.
So, Bob, I think people are prone to talk about bear market territory. And as far as the general public is concerned, because they read this all the time in the Wall Street Journal, for example, 20% down is a bear market. Is that your idea of a bear market?
Well, it's a number that people use, and if we use that strictly, then we haven't had the longest bull market in history, because 2011 we had that much of a decline, or maybe it was 19.9 the S&P, but other things went down more. All of these labels that we use are crutches. They're made for headlines and identify something. Right now, what would we say about Apple? Is Apple in a bear market because it's down 20% more? Well, do we say that about, a number of things? The housing area certainly is in a bear market. But the way I look at it, you've got so many conflicts, growth versus value, for example. And now we're hitting growth, so that's helping value. But value is already down. So I think when the market bottoms, that's why the stocks in the value area probably going to have the biggest bounces initially. But if the economy is slowing down, we'll go back to growth in sometime during next year. And this is the pattern of the market in just forever, which is the market educates you by the way it acts. Like if we have a very low volatility period for an extended time, the risk is increasing, but you don't know, when the black night has come crashing through the doors to interrupt party. But nevertheless, that's the kind of markets we're in. We're in markets where as soon as you get comfortable with what's really working is when you should be most concerned. And you've seen it all year in this past year. It's why people managing money on an active basis are having a tough time, because by the time they figure out what's going to do well, like who benefits from higher interest rates or who benefits from lower interest rates, we just keep going back and forth between risk on, risk off, defensive or cyclical, and there hasn't been consistency. So all we can do now is look for the next change, and I think timing is going to be more important as we go ahead, even though it's, on a long-term basis, buy and hold is what works the best. But you get the most people preaching buy and hold at market tops because they want to feel comfortable buying at high prices. And I don't know how much of a distribution pattern, how far we are into a distribution pattern in the market, but I know that a lot of stocks are already well along in bear markets and maybe ready to bottom to go the other way for a time. And so I think that I want to be gearing up with some cash to put into stocks as we go toward the end of this year.
Bob,
if my assumption, which is, is always dangerous. You make an assumption, and if it doesn't fit with what you think, you can be left behind because the market does something different. But nevertheless, I think when people get to the point of thinking open end on the downside, then I think we have the chance for a pretty good low that will at least give us a good intermediate or counter-cyclical move.
Bob, having had a front row seat on all this since the 1950s, what does this era remind you of most?
Well, I think it's distinctive. We're in the sense that there's so many things happening that I haven't seen before. I mean, when I talk about the market with traps, I'm sure it's happened before, but I don't see that there is a period that I can recall where it's just like this. I mean, the markets, I know you shouldn't say it's different this time, but we've been developing into something different. And it's why I believe that using the recent past for your precedent on what's going to happen, or, just looking at the traditional thing of the idea that when you get an inverted yield curve, then you're getting a warning that the market might be near a top. And we're getting a lot of damage here without having had the yield curve inverted yet. So the markets are, I think, distinctive here.
Bob, you said that the markets are dangerous and it's hard to predict. At our fall conference, Dan Druckenmiller said that he's having trouble reading the market because algorithms so distort the price signal that he's no longer getting the information that he would normally get from, buying and selling and market opinion. Do you think that the market's less instructive as a teacher now than it used to be?
It's a problem that I'm having, which is I want to believe what I've learned over many, many years, like there's a breadth divergence before every top, and there's markets follow through with momentum when they break out or they break down. And a lot of that isn't working. And I think it is the algorithmic programs that have been set up to trade against the obvious on the charts or on the signals that we look at. And in some ways, that's probably true of the sentiment numbers as well. Like right now, we have conflicting sentiment numbers. Put-call ratio is looking good. That's why I think there may be a bottom between now and the end of the year that'll be at least tradable. And I think the other things, though, are it's something that we have to learn from and figure out what's the right contrary to make. I know I'm not speaking clearly here, but I do agree with what Stan has said about that. And for me, it's been a similar problem. But I'm trying to turn it around and saying I'm going to go against the obvious each time. And I would say 4 out of 5 times that's going to work.
What's the obvious now that one should fade? How does one be contrary now?
The breakout in the Treasury yield, that to me seems to be a contrary, or potential contrary. It hasn't failed yet.
That rates, in fact, might come down.
Rates come down as the next step. Yeah. Even though I think the long-term or the secular trend is changing for rates. I've
forgotten what year it was, but you gave some advice not so long ago to college graduates that the financial world is changing and perhaps will not be so profitable a career path as had been, and that manufacturing might be the thing to do. How would you couch that advice now?
Well, I do think that the financial business is changing, and it has been supported by the Fed having a very easy policy and very low interest rates that say there's no place to go but the stocks. But that's changing. And I think lower rates of return will be changing. I think there'll be less opportunity in the financial area once you get the recognition that stocks aren't having the kind of returns that are expected. I think the pension funds are going to have trouble with that, particularly since a lot of the public ones are underfunded. But I think in a general basis, it's something that is likely to continue to make it difficult to make money in the stock market, and then there'll be certain areas that'll do well. I'm thinking of different things, like analysts are not as in demand, in my opinion, now that we have so many ETFs, because
right.
They just buy the stocks because they fit in the sector or fit in an index. And you don't need an analyst to tell you that. You got a different type of guy, a mathematician maybe. But the manufacturing is something that I just took as an example of what's out of favor, and nobody wants to go there. Then that's probably where an opportunity is developing. And I think that's still likely true, but it's maybe, what is manufacturing? Is it manufacturing computers and technology systems, or is it steel and copper and basic stuff? So
one of the things we uncovered, Evan Lorenz uncovered it, was the fact that there are upwards, almost, not quite, $1 trillion worth of so-called unicorns out there. That is to say, privately held companies that are valued by someone at $1 billion or more. Uber being, of course, a preeminent example, with a prospective value, or so say the investment bankers, on $120 billion on some imagined future IPO. What do you say about these things, about the prevalence of private equity, about these non-traded private companies, especially in the light of the shrinkage of public companies? Does that tell you anything about the market environment?
Well, it kind of combines with the buyback of shares, which are, setting records again at very high prices, or the bottom of a cycle nobody wants to buy, or you look at the figures, they don't buy back. But with that said, it just seems like you're getting more and more illiquid if you're going to be emphasizing more and more private equity firms, and it will contribute to illiquidity in the exchange or the traded market. I know people make the case that algorithmic trading is really increasing activity and therefore liquidity, but you see stocks disappear 10% overnight, 20% overnight, and this is like an institutional market. But I think that there's two things. One, I think if you're going to get more and more involved in private equity, you're going to have less and less liquidity when you may need it, when you have to find some way to raise money. And I think also from the standpoint of active versus passive, probably the turning point for active managers doing well on a consistent basis again is when one of the leading magazines will run a cover story on the death of active investing. That hasn't happened yet as far as I know, but it's an interesting comment. But I think from the standpoint of hedge funds, which also fits into this, hedge funds have disappointed people because they went to hedge funds because they were afraid. They didn't want to get hit with 2008 again. And so now that returns are going down, they don't want to be in hedge funds because they didn't do so well in them before.
Your ninth rule among 10 rules to live by says that when all the experts and forecasts agree, something else is going to happen. What are the pernicious consensuses or the pernicious consensus that you see today?
Well, it's certainly that rates are going higher, bonds are going down. Recently in September, we had the highest short position on bonds, I think, or on bond futures ever, or certainly in many years. But I think the whole picture is clouded for me. I can't tell you what everybody thinks right now, other than that rates are going up, the economy is going to be okay, earnings are going to be higher next year, and I think there's lots of room for disappointment in the forecasts that are there that I see as the sort of majority forecast.
Bob, I know one of the things that you have dedicated your very rich life to is the New York Foundling. You're a trustee for a long time, and indeed the Foundling honored you with,
right.
I guess just recently, right? Tell us what the Foundling does and how we might help the Foundling do what it does.
Well, the New York Foundling is an organization that takes care of children at risk, and they have a number of programs that they follow, from taking care of mothers who are single mothers that can't take care of the children themselves, and that's kind of the way people think of the New York Foundling: baby left on the doorstep and the nuns come out and take care of the baby. But that has gone into foster care, and there's a series of other things. The one that I'm most enthusiastic about is the educational program. The New York Foundling has sponsored a school called the Mott Haven Academy. It's a charter school, and the whole idea was they served that community with all kinds of social programs and foster care help. But this is the first time they've stepped into education as a way of ending the cycle of poverty. So what they've done, early intervention and access to quality education is, to me, a great way to help a community out of its cycle of one generation after another not doing well. And Mott Haven happens to be one of the poorest counties in the country. And so it's quite an experiment, and it's going very well. So if anyone is interested, I can get them more information on all the things that the Foundling does, and would certainly appreciate any support they can give.
Yeah, well, New York Foundling,